Thanks so much for tuning into this earnings conversation with the management of APL Apollo Tubes. Anubhav Gupta joins in right now to talk about the quarter and the year that went by and how is APL Apollo poised for FY22 and years ahead after having, well, in a manner of speaking, a path-breaking FY21 for the company. Anubhav, good having you. Thanks so much for joining in. And can you put the quarter into perspective? Because I reckon that there were some disruptions around in the month of January, which in the con call then you had mentioned that you believe you would get over the hump. Then you guys declared what the volume numbers were looking like at the beginning of April as well. Have the eventual numbers come in line with what you had thought they would for quarter four?
Sure. Thanks, Niraj, for having me here. So when we talk about quarter four volume and performance per se, in quarter four we did volume of around 435,000 ton, which was like 10% below our Q3 and Q2 run rate, what we had achieved after the lockdown was lifted. And we were expecting a bit of breather in month of Jan and Feb, because if you see that we had a non-stop sales momentum which started right in May 2020 when the markets had reopened. We were among the first ones to restart our plants and we went very aggressive on the rural sales expansion. We got new distributors and our market share improved to 50% from 40% within the next 6 to 7 months. So we were expecting some breather to take place in month of Jan and Feb. So our expectation was that we should be closing the quarter around 470, 475. But yes, I think the breather got prolonged by a few weeks. But what we were seeing was that the secondary sales for our distributors were very strong because the construction activity on ground was picking up right in Jan, Feb, and March. So we didn't lose our heart. We believed that once that primary sales should come back, and it did come back very strongly in month of March. Right, so March was our highest ever sales volume month. And yes, I mean, we could have sold 20,000 higher, but we were sure that the primary sales would come back really strong, which it did in month of March.
Okay, is it looking slightly sketchy for the months of April and May because of the lockdowns across the country?
So before I get into April and May, Niraj,
now a bunch of questions for March as well. But since we are on the topic of volumes, I just wanted a sense of volumes for April.
Sure. Okay. Yeah. Sure. So yeah, I mean, April momentum was strong, which we carried from month of March. But during the later part of April, we started seeing the second wave hitting really bad in our country, and the various states announced simultaneous lockdowns. Okay, so that did impact the run rate, the volume, and May has been slow, of course, right? But June again, if things do improve, which it seems, I think we are on a strong footing to cover our volumes as much as we could. I mean, you have the demonstration in FY21 how quickly we ramped up our volumes when the lockdown was lifted. So we are all geared up with our plants, with our sales channels, with our distribution. Everything is ready. So yeah, we just need some support from the economy, and we can go really strong.
Okay, well, all the best for that. Now let's talk about a bit about and dissect a little bit of the internals too. I looked at the Ebitda Per Ton, right? It improved quite tremendously. I reckon you guys have said it's on the back of an improved mix and a lower discount, and probably because of contribution of the high margin products also increasing. Tell us a bit about that, and tell us whether this is something that you reckon you can sustain in the quarters ahead. This mix, these lower discounts, if you will, because of the market share that you have, and contribution of the high margin value added products.
So let's break it. Let's look at our EBITDA bridge. Okay, right from like FY20 where we were at 3,000 rupees, 3,300 rupees per ton, and in FY21 where we closed at 4,150 rupees per ton. So the major contribution has come from the value addition, which added almost 500 rupees per ton. Okay, and this value addition is not a one-year phenomenon. We have been working on this strategy for last 5 years. Okay. FY21, we closed value-added product portfolio at 57% mix, which was 40% 5 years ago, right? So we introduced new products in last 4-5 years. We marketed those products, and they were high margin, they were better margin, and we developed the market, and now they are like majority of our sales volume today. So this is pretty much sustainable, right? It will only go up from 57%. We think that the value-added portfolio mix could be 70-75% over the next 3-4-5 years. So this 500 rupees per ton is sustainable and should go up gradually. Then the second reason for our margin expansion was the cost control measures, which every company took when the lockdown was announced last year. So whether it is fixed cost, whether it is a variable cost, we worked on all the fronts. Okay, so that again looks very much sustainable. Then the third element is brand premium, which added around 200-300 rupees per ton to our EBITDA margin. Again, we started spending on our brand 2-3 years ago, and this is giving good. This has started yielding results now, right? And this will only get better as we improve our as we keep on spending on our brand strengthening. So equity enhancement is one major focus area for the group. And then the fourth element is the pull demand, no sales discounts. What we mentioned in our conference call yesterday, that what's happening is there's a major shift from the unorganized sector to organized sector. Okay, and this is majorly, and the unorganized sector is suffering because of supply chain disruption, material availability, etc., etc. So right now there is a very strong pull for the branded players in our industry, and that's helping us achieve extra margin. So we'll see that how much it is sustainable. But even then, we believe that we could generate 4,000 to 4,500 rupees per ton kind of EBITDA on a very sustainable basis, which is a big jump over last year 3,000, 3,300 per ton.
So for Q4, you were at 4,750 per ton. Is that
Yes.
Right?
Yeah.
But you believe the sustainable levels are 4,000 to 4,500?
Yeah, 4,500. Yes.
And you guided that by FY26, maybe you will inch up to maybe 5,000 per ton.
Yeah. So like I said, FY21 basis 4,100. So every year you should see gradual improvement of 200, 250 rupees per ton as we look at operating leverage. Our brand premium goes up. Our value added portfolio mix will keep on improving, and the cost control measures that we like, that's into our DNA, that we keep on working on reducing costs.
So Anubhav, would this be a conservative estimate that you would reach 5,000 in 5 years' time? Because the pace at which you moved from whatever you were 3 years back on EBITDA per ton to where you are right now, these numbers because of a higher base, or is it just that you are conservative right now?
Yeah. See, I mean, like for 4-5 years, Niraj, we were like in the range of 2,700 to 3,300 per ton, right? So I think, like I said, we are very confident our system is capable of producing 4,500, and if market helps, right? If the situation is favorable, right, then we can go to 5,000 per ton much earlier. But
Okay.
we don't know how the macro factors will play out, right? How much full demand will remain, how much push sales have to be done, right? So keeping everything in mind, we are sounding conservative. But yes, if there is natural demand, right? If there is natural pull, 5,000 per ton is what is being done today also, right?
Yeah, that's true. Okay, just a quick follow-up question since we're on the topic of margins. It's evident that a serious commodity cost push, raw material inflation hasn't hurt you, because I presume you carry very little inventory, some of it or most of it would be passed through. So in the same parlance, would it be safe to assume that if commodity prices were to dip as well, or even if they rise further from here, your margins do not get substantially impacted either direction because of that measure? Would that be a fair assessment?
See, if you look at our business model, Niraj, okay, our business model is that we procure steel, which is our core raw material, and then we within 20-25 days of lead time, we convert that into a brand, our product, and we sell it in the market, right? And this is not only in India. Niraj, you look at globally, the steel tube producers, right? They work on a pass-through model because it's not possible for any player to keep increase or decrease of steel prices to its own chest, right? You have to pass it on. So there's a very clear understanding between all the partners in the value chain that steel tube producer has a business model of passing any revision in the steel prices directly to its distributors, and then those distributors pass it on to the retailer, right? So I guess it's a very well-established business model globally, which everyone is following. Okay.
Okay.
So yeah, I mean, steel prices have gone up. Same way we have increased our pricing. When they go down, similarly we'll have to reduce our pricing. So and one has to be very efficient within 20-25 days of lead time. If you can manage your inventory, then the impact will be very little, very minimal.
Okay. What's been also remarkable is the way you guys have reduced your working capital days, right? If I'm not wrong, I read that it's now sub 5, and you expect it to stay that way.
Today it is 8 days, okay, which was 25 days in FY20, like March 20. So yes, I mean, we worked on our inventory, we worked on our receivables, every segment we did work, right? And we believe that it should remain in single digit going forward.
Okay, so 8 days. Sorry, I read in a report they mentioned that it's less than 5 days, so which is why I was asking. But fair call, 8 days is quite exemplary as well in the line of business that you are in. I'll keep that up. My question therefore would be that with all that you're saying, that the EBITDA per ton at some point of time improving further, the working capital days being what they are, and therefore efficient capital management, maybe market share gains from the unorganized space or otherwise, all of that. Are you of the belief that whatever the growth rate numbers might be, and I'll come to that in a moment, but that growth will be accompanied by much higher return ratios, say over the course of the next 3 years? You've traveled a particular journey till now. Do you reckon you can crank it up a bit further and move, so to say, in the next orbit of sorts on the return ratios front?
Yes, Niraj, if you look at our core business ROC, that is already giving us return of 30-35%, right? At organizational level, company level, you see it at 26-27%. But that also given the fact that we are operating at 60% utilization, right? Our sales volume run rate was 1.6 million ton when we have capacity of 2.6 million ton, right? So if we look at the utilization level, which will go up, if we look at the incremental sales volume, which will bring higher margins, right? So anyways, my EBIT will go up, right? And my base denominator, which is gross block, which is already in the books, fully factored in, and working capital, which is only going up by 8 days, right? So my incremental ROC has to be much superior than what you are seeing as on FY21. So yeah, I mean, we are well confident that we should be like our business model has potential to generate much superior ROC.
What is the definition of much? I mean, it could be multiple levels. So
yeah, so I think above 30%. I mean, in next 1 year, 2 years is pretty much possible.
Okay, that's interesting. And market share, Anubhav, I mean, I believe you've cracked it up to 50% for the better part of the year, right? What's the outlook there now? And would you look to gain more market share, or would you now make a choice that let me not sell if the margins are not very high because you want higher value-added products, so on and so forth? So, and again, the market share definition also pretty loose, right? Because I don't see too many competitors out there within the listed space, at least for you. So even that's a bit loose. But what's your definition of the market share, and where do you see it, say end of FY22?
Yeah. So Niraj, for us, what is more important than market share is the market creation, right? Because we are the dominant leader in structural steel tubes, right? So it is our responsibility that we have to create new market, create new segments, right? We have to replace structural steel tube with conventional construction products, which we have been doing, whether it is wood, it is concrete, it is long steel products, it is aluminium, or it is light steel structures like steel angles and channels, right? So our whole focus is that we should create new market, right? And when we create new market, we do get dominant market share there, because because competition does take 3 years, 4 years to copy and bring those kind of product lines, those capacities, right? So so yes, I mean it's a very small industry today, 4 million ton on a steel consumption of 110 million ton in India, right? That's quite low when we look at other I mean economies. Forget developed economies, but even the developing economies, the proportion of structural steel tube is much higher in the overall steel consumption. So which is 10%. India it is 4%. So our whole focus is that how we can take this 4% to 10%.
Okay.
Right? And for that we have to come out with new products. We have to create new market, and we already have like good pipeline for the next 2 3 years. Right? We have clear strategy that what we have to do to grow the market. So if the market say grows by like it has been growing in double digits for last 5 years, for last 10 years. So if we could continue that market growth, the creation, right? I mean, even with 50%, 55% market share, we could be like growing at double digit in the long term sustainable manner.
Yeah,
so yeah.
Double digit, Anubhav, double digit from you would be actually considered a miss, right? By the standards that you guys have set. Are you saying that with the base being so high or base being higher than what it was in the past, the growth rate, while double digit, would come off from the heady higher teens or northwards of 20% number that you've shown thus far?
Yeah, so I think 15 to 20% is what we look for our group in the non-pandemic period, right? That's important, right? If we keep on getting hit by these waves and lockdown, right? So then it is not possible. But yes, the idea is that in non-pandemic period, we should be growing at 15-20%. And like I said, we have good visibility for the product lines, for the new market where we want to cater. We are working on few things, and hopefully if they materialize, then yes, I mean 15 to 20% growth is possible in a sustainable manner.
Okay, now you already said in the con call that you're not going to raise any money, so I'm not going to waste that question there. One last question that I have is on something that I heard or rather read in one of the reports which quoted you as having spoken in the con call. And I just wanted some understanding there that you guys are getting orders for larger section pipes, and you're presumably working to bag an order of nearly 400 crores from a state government. Now, while you've been market leaders, you've been able to dominate pricing and therefore higher margins. Aside of the fact that higher margin value-added products are in the mix, I'm presuming that the margins on your orders themselves are high because you've been able to control pricing. Could this, if you expand into state government orders, bring down your pricing capabilities, power, and could it extend the working capital cycle as well?
No. So it's not about like state government order, Niraj. What we meant over call was that we, like I said, we work to create a new market for structural steel tube. So now we are working on high diameter, high thickness tubes, which are replacing concrete columns and long steel products, because tubes are more efficient. They have better weight to strength ratio. So they bring the overall tonnage down, which is directly proportional to the project cost. So that means that you can also bring the cost down. Okay. So right now we are in the promotional phase, right, where we are promoting our tubes to the contractors, to the government agencies, to the designers, to the structural engineers, and to the architects, right? So in this promotional phase, you try to pass on some benefits, and these are very high margin products, right? So you pass on some benefits to your end customer, so that they get used to this product, and then once it is established, then it will be like then it will be self-sustainable in terms of marketing, right? Word of mouth, etc., will go out in the market, and we are confident that it will be spread like a wildfire once there are like established prototypes of steel building, whether it is a hospital or oxygen plant or a warehouse or a cold storage. So I think the order size or the margin wouldn't matter here, right? What will matter is that we should be able to successfully demonstrate that structural steel tubes can be used for heavy structural construction, right? And if it is a proven fact, then we will be playing a very big role in the overall $250 billion construction industry in India for the next 5 years.
So this is more a product display / marketing initiative, so to say.
Yes.
Okay, great. Well, wish you all the best for that. And congratulations on a very healthy FY21. We wish you a great FY22 and beyond.
Sure. Thanks, Peter. Pleasure.
Thank you for joining us today. And viewers, thanks for tuning in to this conversation with APL Apollo.